Very good morning, Anup, Yogesh, Monica, Yash, Hardik. I think very less students are there because it is Sunday morning. I never realized that. I
Yeah,
thought today's youth are very vibrant.
no, actually, Ganpati festival is also going
I
on.
agree. Yeah, I definitely agree with that.
I'm recording the lecture, so if anyone wants to take the benefit, he or she can see the recorded lecture.
Yeah. So, yes, Vanshika is here. I think then we can slowly start so that by the time they can join, as I have one more lecture at 10 a.m. So it will we definitely like to wind up and give you the proper uh, information, my views, my ideas regarding the investment post-COVID. That's the first thing I would like to do today. Very good morning, everyone. I myself, CA Priti Parikh, is only going to share my views that what are the changes in the investment pattern, investment strategy post-COVID. I'm I'm very sure that my voice is not cracking and you are able to hear me. Am I correct?
Yeah,
Thank you
Yes,
so
ma'am.
much.
Yeah.
Thank you so much. Yes. So, first we go for the word called finance. Because without the finance is said to be the lifeblood of an organization, of an institution, of a partnership firm, of an individual. Without the finance, there's a question of saving, there's a question of investment. So, finance is actually derived from the Latin word called fini, finis, and old French word called fin means end. But in a 21st century, the meaning of finance has been shifted to management of money and money's worth, equivalent to money, check, bills of exchange, promissory notes, hundis, cryptocurrencies, bitcoins, everything become money and a money's worth. Foreign exchange, foreign currencies, they are also counted as a money. And how do you manage that? That is called as a finance. And because if you know the finance of your family, then it might be possible that you do decide for investing after know your what is your budget, the individual budget. Your personal finance can be related to your career planning. Maybe your next goal will be marriage or a holiday planning, etc. But unless you set up your goal, you're never able to decide how much finance you need and how will you arrange for that finance. In 19th century, before the decade when I cleared my CA, for me the simple equation was income minus expenses is equal to saving. And this saving, we will invest according to the herd mentality. Like I will ask my parents, I'll ask my friend, I'll ask my elders, where do they keep the money? And then we used to invest it. The entire equation is changed by you youth people, by young people, millennials, which guided me that income minus first the saving and then the expenses. What was the scenario in the initial stages? That people had a responsibility, lot of responsibility because the education and all was not so easily manageable by the parents. They used to shift the cities, they used to come from the rural to the cities, and they used to settle up there. So first they used to pay for their fees, for their rental, for their food, and if something is left, then they will think about investing. But now the scenarios change. Last year only of your college, last year of your MBA, you are picked up by MNCs, by international companies, depending upon your forte. And once you're picked up, you are easily able to have a good package. And this package, people, because of the education and because of the need of an hour, they find out that out of whatever they receive every month, they will save so much amount of money, maybe for whatever the goal they have, maybe for the whatever the future ambitions they have. And what they save, they've also learned in many of the subject, okay, in the dead saving is when you hide the money under the hip of a sari or under a gulak. The money should be kept on rotating. So they decide how to invest them also. For this investment, the digital era is there to help them out. But the scenario has completely changed, that even the young people have started investing at a very small age. Even the saving and investment is for the emergency fund, whose requirement is different from individual to individual and from family to family. So you need to have an emergency fund, which is possible if you save from your own income, and the saved income is kept in such a way that it is available to you when the emergency arises. Simple question means finance is over. Then what is an investment? An investment is sacrificing today for tomorrow. Now, what is this? You sacrifice today. You give. If you had a today 10,000 rupees, or if you have a today 50,000 rupees, you would have done a huge party at Grand Hyatt for your birthday, or you might have gone for an excursion, on a trip to a Karjat or a family vacation at Lonavala. But you're sacrificing today. You're not going to use that money. You're going to give this money to some trust. For example, the mutual fund trustees, or for some investors, angel brokers, who will take away your money, put somewhere, so that in future, for your goals, you will easily get the money. And this is the reason why today's rupees is always considered stronger than the rupee of tomorrow. For example, if you step down at Rajubai Sandwich opposite HR College, when I was doing my MCom in HR in 1986 to 88, at that time, his father used to give me the sandwich for 25 paise. Paise coins are the same. Same is a sandwich, the bread and the stuffing with a little bit change in the taste. The same sandwich you buy, minimum 40 to 50 rupees. What is the difference? The value of rupee has deteriorated, so the cost has increased. And so the same sandwich is available for 25 paise is now available for 25 to 30 rupees. So it is very strong that when you sacrifice today, you should get something in return in future, which should be definitely more than what you sacrifice, which should be lowering enough for you to sacrifice. So investment is nothing but sacrificing today for a better future tomorrow. It is about taking a financial decision. And there are many factors which can affect the investment, like what is your income, what is the cash flow, what is the capital of a company, what is the family security, are you the sole earner, do you have to take a responsibility of your education, or do you have to take a responsibility of a dependent brothers and sisters, what is the standard of living, what is your knowledge regarding financial understanding, are you from the commerce background or the science background, what is your savings, and what is the liquidity of investment, and ongoing advice. Well, liquidity of investment, I'd like to tell one story. In one motel in Canada, one chief came to the motel, and on the registrar desk, he kept a 1,000 euro note as a deposit. And he said that the motel is a residency plus the restaurant. He said that tomorrow he's expecting few guests from the other provinces. So he wanted to go and visit the motel to find out which room will be suitable for the guest. He goes on the first floor, the second floor, the third floor. He checked the master room, the prince room, the queen room, and the king's room. And it takes approximately 1.5 hour tour to him to finally decide which room and what does he want to change in that room. In that 1.5 hour, that 1,000 euro note, which was lying on the desk of a registration, uh, when he went for a tour, the grocer person, the person who is to supply restaurant the wheat and the wheat flour and the cheese and the milk and all, he came and he asked for the settlement of a bill. So that 1,000 euro note was handed to him. When he went home, on his way, he met a milkman who used to supply him with milk and a dairy product. He asked him, requested him to settle his bill because the Christmas was on his head. He gave the same 1,000 euro note to him to settle up his debt. The milkman, when he returned back home, he asked for the fodder person to come and collect some amount of his bill, which will help him to clear the bill and get more fodder for his cows. So that 1,000 euro note traveled to the fodder person also. Like this, 1,000 euro went on exchanging approximately 8 hands and finally reached to a shopkeeper who came back to the motel and said that he wanted to clear his food and his food bill for the entire last week. And he gave the same 1,000 euro dollar back. So by 1.5 hour, the owner of that 1,000 euro can come back, which is given as a deposit to find out which place is good for his guests to stay. The $1,000 went for a round and cleared approximately 8,000 euro debt till it reaches back to him. It might be possible that it might not reach back to him, but it is very sure that liquid money has more ability to clear the debt than the idle money. Initially, the people used to save the money in the gulak, hide them under the mud. They used to hide them under the mud. They used to put them, the temple pujaris used to put them on the gold coins on the top of the gumbaj. So this was a reason why forest investors used to break them, and there used to be the fall of Asharfiyas. This is a dead investment. And this investment, you might think that, say, 500 rupiah bachai, why should I put into the bank? Why should let it lie into my drawer? That 500 or 5,000 rupees, whatever you have, is of no value to you. Even if into the bank, you get a mere interest of 20 to 30 rupees, which is just equivalent to one sandwich. But if you put your money into the bank, and if the bank is approached by a small entrepreneurs like Panwala, and he gives them a small 3-month loan of 1,000 rupees, including your 500 rupees note, will be a great help to an economy. So money, if it is not rotating, is collecting a moss. So investment is a must for every future citizens of India. If you don't remove your money from your own pocket, if you don't remove your money, which is idle for you for a particular, say, 20 days, yet you invest them. We have a 91 days treasury bill of government, T-bill of government. We have a 182 days T-bill. We have a 365 days T-bill where you can put your money. So the main objective of investment should be your safety. Your money should be safe. Your friend says, "Arey yaar, Reliance ne mere ko last year 100 rupees ke share pe 100 rupees dividend diya." But you think your friend got it. Will you also get the same? Will this be available to you also? So you are thinking about the growth from where you want to invest your money. You're thinking about the income which you'll get from an investment. Some investment are tax exemption like NSS and PPF and all, where they don't have to pay the tax. The entire money invested is tax-free. So that is also one of the objective of your investment. But whenever you ask anybody to shell out the money, the two things they expect is, will my money be safe? That is a risk factor. And how much will I get back? That is a return factor. So investment is a side of a coin, which has two sides. And two sides means one is a return and one is a risk. Every investor, they wanted they wanted to have a high return, but they wanted money safe also. So ideally, people want high return and lower risk, but it is not possible. If you want to have high return, you should take high risk. You should be volatile enough to take a huge amount of risk. And if you don't want to take risk like a middle-aged people like me, then don't expect for a more return, right? So post-COVID, before COVID, the young people were learning to take more risk, invest more into the equities. At present, out of the India's population, only 20% invest in equities. Out of 20%, 80% share is the share of the young people like you, because you are ready to take a high risk. But after the post-COVID, this has changed. When we used to save the money under the hip of the sari, we were taught that it is a dead investment. Put the money into the bank and follow the zero balance method. Every evening, clear up a cash box, put the money into the bank. Next day when you come, bring the money from the cash bags for your regular working capital. This was taught to us post-COVID. The COVID has changed the scenario. No. Keep some emergency fund with you. There is no time in a post-COVID. If there's a lockdown happening, lockdown 1, 2, and 3, you might not be able to go out to remove the money, and it will not be possible to buy each and everything online. So there is a first change which is introduced post-COVID is we are going back to the old ages, some emergency fund. The difference in the post-COVID and the pre-COVID was post-COVID. The post-COVID people have started putting a fraction of a percentage of money as emergency fund in their home. Pre-COVID, they were taught to have a zero balance. And in post-COVID, they've started introspecting themselves. We've heard about KYC, know your customer. But now, post-COVID, they've taught you to know yourself. They wanted to teach you that you should plan your investment strategy as per your own self, as per your own needs, as per your own goals. You should not plan according to the herd mentality. You should not follow what your friends are doing. No, you should not follow what your elders suggested. The only reason for this is because you might need a money in 2 months and they might need a money after 3 years. How can they match your same investment? So first important thing is know yourself. What are your goals? What is the time horizon? What is the risk appetite? Once you know yourself, you have to decide. You have to invest your money in the post-COVID era, like value investing. Now, what is value investing? Find out about the stock which are undervalued at present. They are available at $3.99. But according to your study, according to what you must have learned, to find out the future expected return, to find out the holding period return, you think that $3.99 within a span of few months, a small period, it can become 39,999. So find out such type of stock, invest into it. They are called as an undervalued stock. And this can be possible with the help of a fundamental analysis and a technical analysis, what is taught to you. Or you can search on your own line and decide how to do the fundamental analysis, how to learn the charting technique, and you invest into it and you do the value investing. This is what is the first thing what you have learned post-COVID. Before that, you used to follow the certified financial planner, the certified financial analyzer, the angel brokers. You used to look for the SEBI investors guidelines. Now you have learned to analyze yourself and make an investment. You can even for a growth investing. What do you mean by growth investing? You find out the funds you find out the stock which is having a higher growth. And this can be possible by comparing with the peers, by the different competitors in the same market, by comparing it with the industry average. And once you decide this, you invest into them. What is the difference between a value investing and a growth investing, which you have studied the post-COVID sitting at home, that you plan out, you are very ready to depart from Mumbai to Kolkata. You know in which train can make you reach faster. You know how much time you can reach there. You know which compartment you want to travel, where you will be able to get all facility. So you're standing on the platform, the train comes, you sit inside and you reach your destination. That is value investing. You have done a very good research and you're investing the money. In growth investing, the young people like you, they have not done a research, but they observe. The train comes on the platform. You see the indicator, it is going to reach Kolkata on this time. It is going to reach in this much time. And before the train starts, on the last moment, you jump into the train and reach your destination because you know it is a growth investing. Some people like us, we also follow the income investing. Some people like us also go for the return on investment, which are of two types. The regular income in the form of interest or a dividend, and sometimes the bonus units or the cash units also. People do investing for income purpose also. If you are working hard for your money earned in this post-COVID era, when many have lost their job, when many have got the cut into the salary, when many are unable to face a competitive phase under the COVID pandemic, they look for the conservative investing. They look to see the safety of the money. Let it be the less return out over the available. And aggressive investing is a people like those who are ready to take risk because they want a higher return. Then, So according to that, your investing pattern has changed. You decide if you're in the age of 20 to 30, your goals, education, marriage, holiday, you're very expected to return high risk, high appetite. You have a liquidity is very low. You don't want your money back. So you are ready to invest into the fund, mutual funds. You have to give them a time to grow. Systematic investment planning, ELSs, equity linked security scheme. You're ready to take a risk. 30 to 40, your children education, insurance becoming important. So in that case, you are moderately expecting return. Your risk is also okay. And you want also money sometimes back, not always back, but sometimes back. Same way, 40 to 50, your children's marriage, your retirement. So everything is balanced out. And post-retirement, you are ready to take the risk appetite at all. You want a liquidity of money and post and greater than 60 years, holiday, your estate partner is so important that for you, the money with easily available is more important to you. Because of post-COVID, long working hours, as it is due to the work home model, so there is no time limit. Anytime there's a meeting, anytime your 7 hours or 6 hours a day is completely changed, become a 24 hours a day. There's a changing in a working condition also. You're working at home. So you're saving on a traveling time. You're saving on a conveyance also. And so expenses like eating out, telephone and petrol and gym facilities have reduced during this pandemic. So you have more money to invest, more money to save. And investment you are looking forward is always very secure. What before COVID used to think about investing into the automobiles has shifted to the investing into the pharmaceutical companies. Check the shares of Syngene and Nugent soaring every day high. Pharmaceutical companies. And your first vision was to have a fastest car, the fastest bike, and top-notch gadgets, what you wanted to have now shifted to get a good insurance policy for your family, to have a good house to stay, where in work from home atmosphere, everybody will be able to do comfortably justice to their job. So the scenario has changed post-COVID. So the investment planning process has also changed. First, we used to do assessment, how much money will be left with me, how much I want to invest, set up a goal. What is your goal? You want the money after 2 months, 3 months, 4 months. Create a plan for it. Execute a plan and monitor. That was a process. Still, it is a process, but the way in which it is executed has changed. First, you used to set up your goal and create a portfolio where at least 2 or 3 equities, 1 or 2 debentures, bonds, one of the ETFs was found out. Now there's a more exchange traded fund came into the position. The more liquidity investment started. What first was your target? That 35% you post tax earning, you do the saving, and with EMIs put all together, 45% of your post tax savings you would like to save has changed a lot. You always think from the meditation, yoga, health, insurance, liquidity of money point of view before you start investing into it. So the personal investment planning process steps are same, but the problem is there, the execution, the weightage given to the stock has changed. A few tips to the young people like you who want to invest into the post-COVID pandemic. Don't lose sight of your cash. Whatever money you are having it from your job, from your business, from your consultancy, keep proper count on it. Let your money work as hard as you are working for the money. Shun a disease known as debt, which has destroyed the US economy in 2008 subprime crisis. The credit card, the credit card, the highest used by the young people like you. Use them wisely. Don't create a burden on yourself which you cannot be able to meet up with your limited resources of your salary. Know what is a pecking order of excess if you need money. You should decide that what is the most important thing, how will you spend your money, in which order. Is the house an important criteria or is the car an important criteria? In a COVID, the car has become of no car automobile industries investment. The investment in a real estate is comparatively increased than an investment in automobile because they wanted a place to work from home. They wanted a place where everybody easily can be able to work. Do not fall for the traps and tricks that play on crisis. Do not get carried away by online advertising. This is available for 50% and 70%, but look at your need. Do you need it? Is there any fund which you have allotted to that type of shopping? Shop what is necessary for your family, medicines and the insurance policies and the groceries and the food items and the technical gadget where they can work from home. Correct. And learn to find out about the opportunity cost. If I invest there, then what I'm not investing on it, what will I be losing? And then compare your investment. Don't expect the world to become a virtuous place or a new heaven after COVID-19. Don't think COVID khatam ho jayega, it will be all back to normal. Let me have a party and all. Decide whether it is needed for it or not. Yes, you'll have to guide me once the meeting gets over. How will we continue back again?
Actually, it's like we have 2 minutes 30 seconds. It's a 40-minute lecture actually.
Yeah, so
A
do you want me to wind up early?
If you can, but if you want to continue,
Yeah.
you have to host a meeting again.
Yeah. So could you please host a meet? Same meeting will be hosted again. Same joining.
Yeah.
Please do that. I think I will not be able to wind up in 2 minutes. At least post-COVID investment plan, the industry sector, what according to me is the best for investment can be suggested to that.
Okay, no worries. I'll host the meeting.
Yeah. Till that, I'll continue with all my students. I hope I'm not going above your head. I'm not having a bouncer.
No.
I am looking from the point of view of the young people only. I remember Senator Elizabeth Warren has got a 50-20-30 budget. What was a 50-20-30 budget? Whatever salary you get, whatever profit you get from your management consultancy, from your own boutique, from your own entrepreneurship, you have to divide 50% on your need, 20-30% on your want, and a 20% on saving. And this 20% of saving, 19% should be invested. You are the youth of India for the next coming decade. If you do not invest into the volatile market, the India will not be able to come out from the unfavorable balance of trade, balance of payment, unfavorable balance of payment scenario. They want more foreign exchange, and that is possible even only if your money gets rotating in the market. You strategize your finances for the investment, food, health, traveling. But the most important is last but not the least, saving and investment. You have to understand how money works in the first step towards making your money work for you. If you do not understand this, if you don't put your money to work, if you don't rotate your money, you will not be able to work till the last day of your life. And then the last days of your life will be miserable. So the investment is a must, whether it is a post-COVID or a pre-COVID era. This is what I wanted to teach, wanted to give you my opinion about the positive affected investment avenues, media, pharmacy, utilities, food retail, education, retail estate. People have started learning online many different courses in their interest. I have found the one doctor attending the session for investment avenues and portfolio management, because that was his wish to learn. He didn't know anything debit credit, but he wants wish to learn. So the